Trend lines are a particular tool in trading, but they're often underutilized. If you learn to draw them correctly, they can be just as effective as any other method. To begin, let's identify the market trend direction. Add EMA indicator to your chart from the indicator section. Increase the EMA length to get a better understanding of the long-term trend. Try setting it to 200 and make the line more visible on the chart. This is a simple way to determine the trend's direction. When the price candles are below the 200 EMA line, you're on a downtrend. Conversely, if they're above the line, it's an uptrend. Don't worry, we'll keep things straightforward. We often talk about price moving in waves, some strong and fast, others smaller and more hesitant. In technical analysis, we categorize these as impulsive and corrective waves. These waves are key to understanding how to draw effective trend lines. Impulsive waves are the driving force of the trend. They're the powerful moves that establish the direction. In an uptrend, they are the strong upward surges. Following every impulsive wave, we typically see a corrective wave. These are the temporary pullbacks or consolidations against the main trend. They're essentially pauses before the next impulsive move. Now let's talk about trend lines. In an uptrend, the impulsive trend lines is drawn connecting the swing lows of those impulsive moves. It acts as a dynamic support level, showing where buyers have consistently stepped in to push the price higher. We also have what's called a corrective trend line. This connects the swing highs of corrective waves. In an uptrend, this will generally be downward sloping line, acting as a temporary resistance level for those pullbacks. So we know how to identify corrective waves within an uptrend, but how we can use them to actually enter trades in the direction of the trend. That's where corrective trend lines become incredibly valuable. Remember, the corrective trend lines connects the swing highs of those temporary pullbacks. It acts as a dynamic resistance level, showing where the price has met selling pressure and struggled to continue its upward trajectory. Our goal is to identify when this resistance is broken, signaling a resumption of the uptrend. We're looking for a bullish breakout. A bullish breakout occurs when the candlestick closes above the corrective trend line. This is crucial. It's not enough for the price to just briefly poke above the line. We need a confirmed close above it. This close confirms that the buyers have overcome the selling pressure and are pushing the price higher again. The closing price of this breakout candlestick becomes our entry point for a long trade. We enter the market at this price, anticipating that the uptrend will continue. Why is this strategy effective? Because it allows us to enter the market after a period of consolidation or pullback. Just as the main trend is resuming, we're essentially waiting for the confirmation that the sellers have lost control before we enter a buy position. So let's dive into some real examples and refine how we use corrective trend lines for entries in an uptrend. Here we can see that the price consistently trading above the 200 EMA, confirming an uptrend. This means we're focusing on following those corrective waves to draw our trend lines. Remember, we're looking for those temporary pullbacks within the larger uptrend. Now here's a crucial point. I draw my trend lines using the shadows of the candlesticks, also known as the wicks or tails. These shadows represent the highest and lowest points the price reached during the candlestick's formation, not just the open and close prices. To draw our confirmation trend line, we need at least two of those shadow high points. We connect them with a straight line, creating our initial resistance level. Now, this is where things get interesting. Sometimes the price might touch or even focus slightly above our trend line with a shadow. It's tempting to think this is a breakout, but it's not. We need a candle body to close above the line for it to be a valid breakout. If the price only touches the trend line with a shadow and then pulls back, we need to adjust our trend line. We move the second point of the trend line to the high of this new shadow. We're essentially adapting our resistance level to react the most recent price action, and we repeat this process. If the price continues to touch the trend line with shadow, we keep adjusting it, moving the second point to the new high. We keep doing this until we get the crucial candle closing above the trend line. Finally, here we see a candle that closes decisively above our adjusted trend line. This is our breakout signal. The closing price of this candle becomes our entry price for a buy trade. We enter a long position at this closing price, anticipating the continuation of the uptrend. Now, let's talk risk management. We place our stop loss order slightly below the low of the breakout candle or slightly below the most recent swing low before the breakout. This limits our potential losses if the breakout fails. For our profit target, we can use a risk-to-reward ratio. A common approach is to aim for 1 to 1.5 or even 1 to 2 ratio. This means we're aiming to make 1.5 or 2 times the amount we're risking. So for sell trades, it's basically the mirror image what we do for buys. We're looking for a downtrend, price below something like the 200 EMA. Then we spot those light rallies, the corrective waves, and there are trend line connecting the lows of the candle shadows, those wicks. This time, the trend line slopes upwards. Just like before, if price only dips its toe below the line by the shadow, we adjust the trend line to that new low point. You keep tweaking it until a whole candle body actually closes below the line. That's your sell signal. You'd enter a short position at that closing price. Your stop loss goes just above the high of the breakout candle or the last swing high. You can use a risk to reward ratio of 1 to 1.5 or 1 to 2 for your profit target. Just flip for downtrends. Simple as that. Now let's walk through some real trading examples using the corrective trend line strategy. We can clearly see the uptrend price is staying above the 200 EMA. We identify a corrective wave and draw a trend line connecting the shadow highs. Then we got the decisive candle close above the trend line, our buy signal. We enter at the close, place our stop loss below the breakout candle's low, and as you can see, the price moves nicely in our favor, hitting our target based on our risk to reward ratio. A successful trade, and the setup, the breakout wasn't particularly strong, yet it has still managed to yield a quick profit. Now here's an important example, a losing trade. We followed the same process, identified the uptrend, drew the corrective trend line, waited for the breakout. However, in this case, after we entered the trade, the price reversed and hit our stop loss. This is perfectly normal. No strategy has a 100% win rate. So I've got 6 setups. Out of these 6 examples, we had 5 profitable trades and 1 loss. This illustrates that while the corrective trend line strategy can be very effective, it's not guaranteed win every time. Risk management is essential. By using stop losses and aiming for a favorable risk to reward ratio, we can ensure that our winning trades outweigh our losing ones in the long run.